Before I kick this one off, I just want to let you know that this is a continuation of the last video I've done on bonds called The Beginner's Guide to Bond Investing. So if you don't really understand what a bond is, and you don't really know how they work, then I'll strongly recommend you go watch that video first, and I'll put a link to that video in the description box below. But today I want to delve a little bit deeper into bond investing. In particular, I want to look at some of the key considerations I make before putting any bond exposures in my portfolios. So let's get started. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. To kick this video off, let's talk about the yield to maturity. Previously, we discussed the difference between the coupon rate and the running yield, but there is a third figure which we should take into consideration, and that is the yield to maturity. As we already know, the market value of a bond can fluctuate above or below its par value depending on the conditions in the market. And the yield to maturity takes into account this fluctuation. The yield to maturity represents the bond's anticipated return, assuming that the bond is held to maturity. So it takes into account all future coupon payments of the bond, and it also takes into account the current market value of the bond. So if your bond is trading below its par value, then if you hold it to maturity, there's going to be some capital gain to be made along the way. And therefore, as a result, your yield to maturity is going to be higher. Conversely, if your bond is trading above its par value, then if you hold it to maturity, there's going to be some capital depreciation along the way, and therefore your yield to maturity is going to be lower. So yield to maturity is a great calculation to make when you're buying bonds on the secondary market, because often bonds will be trading at a slight premium or a slight discount to its par value. So by looking at the yield to maturity figure, you're getting a better idea of the internal rate of return of that investment. At the end of the day, if you're always just relying on the running yield, then you're not taking into account the change in the capital value. However, yield to maturity isn't perfect. It assumes that you hold the bond to maturity, which isn't always the case. It also assumes that the coupons are reinvested at the same rate, which again is always not the case. But it is a very handy figure to take into consideration. For me, this is a big consideration to take into account before getting into any bond exposure. As we already know, the coupon rate of a bond is quoted as a percentage of its par value. But there's also another consideration that we need to make in regards to the coupon rate, and that is whether or not it's a fixed or a floating rate. A fixed rate bond has a coupon set for the entire term of the bond. Or put more simply, you're gonna get the exact same dollar figure in coupon terms throughout the entire life of that bond. Or you can get a floating rate bond, which is also known as a variable rate bond, which basically has its coupon rate fluctuate depending on an underlying benchmark interest rate. And it's important to consider whether a bond is fixed or floating, because a change in an interest rate is going to affect the bond differently. It's going to affect the yield differently, and it's going to affect the market value of that bond differently. So let me give you an example. Two $100 bonds are issued at the exact same time. Both have a 5-year maturity and both have an initial coupon rate of 4%. The only difference between these two bonds is that one is a fixed rate and the other is a floating rate bond. The floating rate bond has its coupon pegged to the 90-day bank bill swap rate. If we assume that the 90-day bank bill swap rate is 0.5%, now yes, it's actually lower than this, but for the purpose of this calculation, let's assume 0.5%. Then that means that the floating rate bond is going to give you a fixed margin of 3.5% above the 90-day bank bill swap rate. As time passes, if there's no change in the 90-day bank bill swap rate, then both these bonds will continue paying you the same 4% coupon rate. The difference comes when there is a change in interest rates, which would in turn impact the bank bill swap rate. If interest rates rise and the bank bill swap rate rose to 0.7%, as an example, the fixed rate bond would continue paying you a coupon rate of 4%. The floating rate bond, on the other hand, would adjust its coupon rate to 4.2%, which is a 0.7% bank bill swap rate plus the margin of 3.5%. If interest rates fall and the bank bill swap rate dropped to 0.3% as an example, the fixed rate bond would continue paying you a coupon rate of 4%. The floating rate bond, on the other hand, would adjust its coupon rate to 3.8%, which would be 0.3%, the bank bill swap rate, plus the 3.5% margin. The takeaway from this is that if you expect interest rates to rise, then you want to be holding floating rate bonds. If you expect interest rates to fall, then you want to be holding fixed rate bonds. So in the current market, interest rates are incredibly low, historically low, so therefore I'm primarily holding floating rate bonds. This also ties into movements of bond prices on the secondary market. Now, typically fixed rate bonds are going to be more sensitive to price movements, and that's simply because a change in interest rates isn't reflected in the coupon rate of the bond, and therefore it's reflected more in the value of the bond. However, having said that, a floating rate bond will also have movements in its capital value on the secondary market. If interest rates fall, then you can expect the market value of a floating rate bond will drop, which would in turn increase the running yield to account for the drop in the coupon rate. The value of a fixed rate bond would likely rise, which would lower its running yield. The opposite would happen if interest rates rose. Eventually, in a perfect market, two bonds with the exact same maturity date should have the same running yield. The only difference would be that one bond is holding a capital gain and the other bond is holding a capital loss. So again, if you expect interest rates to rise, you should be holding floating rate bonds. If you expect interest rates to fall, you should be holding fixed rate bonds. If you've looked into bonds before, you've probably heard the term duration, and duration is simply the time until the bond reaches its maturity date. As we've already seen, interest rates play a significant role in how bonds behave on the secondary market. And similarly, inflation and economic conditions will also play a role in the bond's behavior. With a longer duration bond, there are more unknowns. It's a lot easier to predict what's going to happen in the next year than it is to predict what's going to happen in the next 10 years. And so therefore, longer duration bonds are considered more risky. And as an investor in bonds, if you take on more risk, you expect a better return. That is why, in general, a longer duration bonds tend to give you a higher yield than shorter duration bonds. Now, that's not always the case. Sometimes longer duration bonds can give you a lower yield, and that's when we get an inverted yield curve. And if I do an advanced guide to bond investing, I'll go a little bit more into the inverted yield curve and why it's a precursor, or normally a precursor, to a stock market crash. So when would you buy a long duration bond? Well, if you expect interest rates to fall, then you might want to consider a long duration bond. And the reason for this is because basically you lock in a higher coupon rate. All the bonds that are going to be issued after that bond, if interest rates drop and you've got the call right, are going to be issued with a lower coupon rate than the bond that you're holding, so therefore it's going to be worth more. It is important, however, to note that floating rate bonds are less sensitive to duration. And again, this comes back to interest rates. So with a floating rate bond, as we know, they're going to adjust its coupon rate in line with changes of interest rates. So therefore you don't have the same level of interest rate risk that you do for a long duration fixed rate bond. At the moment with my fixed rate bonds, I am opting for short duration. Again, coming back to the idea that we're currently in a very low interest rate environment, if I take a 10-year view on where I think interest rates are going to head, then I think that there's a good chance that interest rates are going to head up from here. So therefore, I don't want to be holding that long-term exposure. If I'm right and interest rates do increase over the years, then I'm going to be able to buy better bonds later on with a higher coupon rate. So in summary, if you expect future interest rates to rise, then you want to opt for either floating rate bonds or fixed rate bonds with a short duration. If you expect future interest rates to fall, then you're going to want to opt for fixed rate bonds with a long duration. In the current environment, I'm opting for floating rate bonds and fixed rate bonds with a short duration. If my economic outlook changes or there's a significant change in interest rates, then I'll adjust my bond exposure accordingly. And if that's all too complicated for you, then don't worry too much about it, because all you really need to do is go out there and find yourself a really good fixed income fund manager. It's their job to take into account what's going to happen to the interest rate, what's happening to the economy, and adjust the bond exposure accordingly. Fixed income is one of those areas where I actually prefer active management over passive management, particularly in economic environments like we're in at the moment. So if you find yourself a good fund manager, then in my opinion, they're going to be able to preserve capital a lot better. Also, by buying bonds through a bond fund, they're going to have access to bonds that you simply can't get as a retail investor, because basically you can get bonds that are listed on the ASX, but a lot of bonds aren't listed on the ASX. They're over-the-counter bonds, which fund managers can get access to, but you as a retail investor can't really get access to that stuff. So find yourself a really good bond fund manager. There's plenty listed on the ASX. Understand their investment strategy, understand their management style, have confidence in their conviction, and then the hard work is going to be done for you. But that's it for me today, guys. Thanks a lot for watching. I know this video was a little bit technical. There's a little bit of jargon in there, so if you kept up with it, then you're doing good. But that's it for me. I'll see you guys in the next video.